So the webinar today is How Will the Market Influence U.S. Elections? Today is Friday the 23rd November, 2 GMT, and my name is Ron William, Principal Market Strategist here at RW Advisory, based in Switzerland. Now, of course, the U.S. elections have already taken place, so I'm kind of playing with the title here, but you'll understand why within the next opening slides. Before I start with the webinar, just a quick check on contact details. Should you wish to send me any questions after this webinar, or maybe just follow up with any other points, my email address is ronwilliampr@gmail.com. ronwilliampr@gmail.com. I'll say it one more time. ronwilliampr@gmail.com. You can also follow my my ad hoc commentaries on Twitter. I think that should be ronwilliam7, and feel free to connect with me on LinkedIn. So they're my general contact information should you wish to stay in touch or ask any questions. Okay, so let's move on with the next slide. I generally like to give an overview of the market approach that I've been following for over 13 years now in the market. And it's generally this top-down approach you can see here with this upside-down pyramid, starting with the macro big picture, breaking down into the market internals, and then at the very end, last but not least, the short-term trading timing setups. Now, what I mean by macro is generally big picture cycle roadmap, so just basically being able to understand historical events and patterns, and by doing so, maybe trying to extrapolate those correlations out into the future. I do also look at correlations between different markets, so for example, currencies versus commodities and whatnot, otherwise known as intermarket analysis. Market internals, what I mean by that is just different types of indicators, qualitative indicators and quantitative indicators. Now, quantitative indicators are the everyday technical analysis indicators that we all know and love, like momentum indicators such as the RSI, MACD, moving averages, but also qualitative indicators such as liquidity flows, option market information, and also just general economic fundamental filters. So I do look at both and believe that it's leveraging the best of both worlds. And lastly, for my timing setups, I do focus predominantly on reversal-oriented signals, such as candle patterns, which tend to give signals in the space of just a few sessions, and a proprietary, well-known indicator called DeMark indicators, developed by the one and only Tom DeMark. With his experience of the last 40 years, he's developed many indicators that are specifically designed for market timing and for identifying exhaustion points within the market. And now, if any of you have any questions about some of the methodologies which I've spoken about, cycles, candle patterns, and DeMark indicators, a lot of this has already been covered in past webinars, so feel free to check the archives here on FX Street, and you'll be able to educate yourself more on that. Okay, so that's my technical approach: macro, market internals, and timing, all part of a kind of systematic way of looking at the market. Now, what I tend to do traditionally is to make the point that this is a global webinar, and I always like to kind of engage each of you here from across the world. We've managed to have kind of very good participation from many countries and around the world, many attendees coming from different time zones and different cultures, all with different market focuses. And so I always like to ask the question, please introduce yourself to everyone on the chat, name, country, and just let me know if you have attended prior webinars or not. So some of you that have attended my webinars, you know this is the routine, traditional question I like to ask. If you could just introduce yourself to each other, name, country, and have you attended these webinars before? And very lastly, my one small request, smile if possible. I always like to begin with happy kind of mode in these webinars. So I'll just wait here for a moment or two for each of you just to, within the chat, just mention your name, which country you're dialing from, and whether you attended these webinars before or not. So if anyone could just voluntarily just put in their details in the chat, please. Carlos, loyal disciple, thank you very much, from North Carolina, USA today. Welcome, Carlos. FX Tough 101, USA, first time. Welcome. Welcome, first timer. And any extras that would like to put their contribution in the chat? I'll wait just one more moment just in case. I see we have one or two others in the chat, but I'll wait for a moment and then continue. But for the moment, we have two participants from the States. Welcome, guys. One loyal disciple. Thank you for being so polite. And a new member, FX Tough from the USA, first time. And then last but not least, Diana Prada from Medellin, Colombia. Welcome, Diana. Okay, so let's start with the webinar. I hope each of you, all of you here, find the webinar of interest. It's just a quick overview on a few points related to the U.S. elections that have just passed. And it's broken down to these three quick sections. Part one, traditional perceptions. I just want to talk a bit theoretically about the debate between cause and effect. So you'll know what I mean as to the markets versus the U.S. elections. What leads what? Does the U.S. elections impact the markets, or does the market impact the U.S. elections? And then we're going to talk about what actually happened this year with the Obama win over Romney. Part two, a quick market outlook, key technical setups to watch out for. I'll talk about the S&P 500 and a big kind of headline on Apple and the sharp fall that the Apple stock has had and what that means for general risk appetite and general safe haven plays in the market. And part three, we focus on strategies, where we'll just be talking about attractive trade setups post-U.S. election, where the key themes are likely to be an unwind in risk appetite and a renewed increase in safe haven investments. So all of this will have relevance to the FX rates that each of you trade here as subscribers of FX Street. But of course, if you're looking at cross-asset classes such as commodities like gold and oil, or interest rates, which are of course very integral to FX rates, this will all have an influence of some sort. So feel free, if you're not sure what these themes, how these themes impact the markets that you like to trade on a day-to-day basis, then just let me know through the chat. We should hopefully have some time throughout the session. Okay, so part one, traditional perceptions. Part two, market outlook. And part three, just a few strategies to keep in mind. Now, the opening slide, I want to open the question to some of the attendees here. It's a kind of a nice, cozy number of participants that we have here, so a specialized number. So it'd be great if each of you could maybe try and participate if you feel that there's something of interest to say. And my question is to each of you here, Diana, Chuck, and Carlos, how do you believe the U.S. elections impact markets? And then there's no right or wrong answer. Just feel free just to kind of share your insight with each of us. We all learn from each other, and I just want to kind of open that question up. So we've had one of the biggest events historically. Every 4 years, the U.S. elections has a major impact globally, and specifically on financial markets. How do you believe the U.S. elections impact the markets? Why do you think the U.S. elections might impact the markets? So Chuck is saying lack of uncertainty. That's a very good point. What do you mean by lack of uncertainty? Election, so uncertainty within the elections or the markets, economic uncertainty. Do you mean uncertainty in the general meaning of the markets? Yeah, very good point. And I'd say that would be a very key point, because the markets, although they had a wonderful recovery since 2009, so we've been in this recovery mode if you look at the U.S. equity markets for just over 44 months, which is a historical extreme by cycle standards of economic recovery from 2009. And having said that, we are looking overextended. Most markets, most risk-related markets, such as the S&P 500, gold, which has switched to risk market for this year, and a few other markets, are looking uncertain. So, Chuck, you make a very good point there. as to this lack of uncertainty in the markets, and Diana also agreeing there, maybe magnifying the impact of the U.S. elections which have just passed. Okay, now I'll move on that point. And now I want to ask the question about a debate between cause and effect. Nice cartoon there of the old Albert Einstein asking the question E equals mc squared. He's obviously trying to work out relativity, but we're going to try and keep it simple today and focus more on just very simple cause and effect equations. Does A equal B, or does B equal C? That's the hypothetical equation that I'm posing for everyone. But before I kind of explain exactly what that means, A and B, I just want to quickly read what Carlos just said. The uncertainty still reigns with no resolution on how to approach the fiscal cliff and its impact on the markets. Yeah, very good point. Market uncertainty in terms of the recovery we've seen from 2009, but also economic uncertainty, certainly in the U.S. with the fiscal cliff, that huge mounting debt which the U.S. government needs to resolve in the coming weeks and certainly into 2013. And of course we have major kind of default risk within Europe, that providing kind of just a general global black swan type of tail risk for most people that look to trade the markets. So thank you, Carlos, for that point. Uncertainty still reigns with no resolution on how to approach the fiscal cliff. And so, of course, who wins the U.S. elections, Obama or Romney? Of course, Obama won in this case. Will give some information or maybe some clue as to how that government group will manage the fiscal cliff and various other economic challenges. And of course that has a direct impact on the market. Now going back to the question here, a debate between cause and effect, I'm asking the question, does A equal B or B equals C? Now what am I talking about? Am I just moving on to a very theoretical physics question? The answer is no. I'm just trying to entertain this interesting question about cause and effect, and what I mean is this question here. Does the financial market impact U.S. elections, A equals B, or does the U.S. elections impact the financial market, B equals C? Which one do you think is more of a appropriate description? Carlos, Anna, Chuck, what do you think? Does the financial market impact U.S. elections, A equals B, or the U.S. elections impact the financial markets, B equals C? It's a theoretical question, but you'll see what I mean in the next few slides. So Chuck is saying B equals C. U.S. elections impact the financial markets, and that's a fair perspective. Chuck, can you tell me why you believe so? Diana's also saying the same thing. U.S. elections impact. Chuck, Diana, why do you believe that the U.S. elections or just general government elections impact markets and not the other way around? Any reason that comes to mind? So Chuck's making a very good point, monetary policies. And of course monetary policies do influence economic decisions and the economy at large and the financial market. Diana's saying because people will impact markets on decisions made by the presidents, I think. And that's a good point. So Chuck is focusing on monetary policies and of course how that affects the economy at large. Diana's actually making an interesting twist there and focusing more on crowd psychology, so the people who actually trade and invest in the markets, they impact the markets on decisions made by the presidents, potentially. And Carlos is saying the health of financial markets is a factor that voters take into consideration. Both answers might be right. Well done. And interestingly, we have a small kind of, very kind of rich diversification of ideas here. And I like it because each of you are kind of feeding off each other, and that's very useful, I think, for everyone. And interesting what some of the points are saying. Now, I'll probably want to focus on Carlos's point and say it is a little bit of both. I mean, there is a feedback loop between both of these causes and effects, and that's just generally the philosophy of this question, or the challenge of this question. There's no right or wrong answer really, but I do want to make a point of focusing on what Carlos has said, saying that the health of the financial market is a factor that voters take into consideration. Both answers might be right. So of course the financial market is important because that will tell investors and traders and voters ultimately which way they choose to vote. But of course the US elections do make a difference to the financial markets, because that also suggests what type of monetary policy and kind of political mantra will be developed in the market. So both could be correct, but I want to lean more on the point of what Carlos said, both of them being central, and maybe focus a bit more on Diana, what she said in terms of the decisions of the people, both in the US and around the world. And the key theme here is social moods. Now, what I spoke about was A, the financial markets, and B, the presidential elections. Now, there was a missing equation there, and that equation, that letter, is the letter C, social mood. Now, I put it to you, something that has been widely kind of developed and evolved by the infamous Bob Prechter within his Socioeconomic Institute work, and then I encourage each of you to look up Bob Prechter's work, or Robert Prechter's work, as part of the Elliott Wave International Group, where they actually study the impact of social mood on pretty much everything in terms of cultural trends, political trends, and financial market trends. And the point made by the Elliott Wave International Group and the Socioeconomic Institute is that social mood, generally social mood, how we feel as a group across the world, the C part of the equation, actually impacts both the financial market, A, and government policy, or presidential elections, B. So C, what I'm saying is that C, social mood, equals A and B. Not to get too technical here, but the point is I'm just saying that there's a new letter, there's a new part of the equation that we should be adding, and that is the letter C, social mood. How crowd psychology ebbs and flows from positivity to negativity has more of an impact than most people state. And there's certainly media, I would say also, tends to understate social mood. I mean, we tend to say non-farm payrolls, unemployment figures come out worse than expected, and so the market is going to do X, Y, Z. Obama wins over Romney. A Democratic wing is negative for the markets, and so there we're going to get a sell-off. And so there are all of these kind of assumptions based on whether an event risk of some sort, whether it's a presidential election or whether it's an economic policy, impacts the market, or whether the market actually impacts the event or even creates the event in advance. And so the point here is, the reason why this is a difficult question to ask is because we're missing one fundamental component to this equation, and that is social mood. You have to ask yourself the question, what is the mass crowd psychology around the world, or locally in the US in this example? What are they feeling? What are they believing? Are they believing that they are in a positive mood or in a negative mood? And how are they deciding to reflect that decision? And that, of course, is in terms of trading decisions, investment decisions. This is telling us which direction social mood is pushing in terms of, are there more buyers in the market? Are there more sellers in the market? This tells us something about social mood, and it is social mood that leads to the financial market, which then leads this event risk. That's the point that I'm actually suggesting to each of you here on the chat. Now, does that make sense? So I just want to make sure it's clear. All I'm saying is social mood, this new part of the equation, letter C, equals A and B. Okay, so Carlos is saying, and that played a role in the past elections. Absolutely. So it's this election and every other election throughout history over the last century and beyond, in the US and other countries, social mood impacts everything. But of course, in this webinar, we're talking about the elections. Now, I want you to keep that in mind, not just in terms of the US elections, but also in terms of general event risk. So that could be economic numbers which come out every month. Think of the famous non-farm payrolls that come out once a month. It could be GDP figures. It could be fundamental data, so earnings release on certain stocks. It could be interest rate differentials for various FX currencies that you're looking at. Whichever market, whichever event. The point that we're making here is that social mood has a great influence on everything. Okay? Now I'm going to move on to prove that point, building on from what Carlos just said. History does prove that social mood, which is reflected in stock market performance in terms of the trading decisions that investors and traders make, bullish or bearish, stock market performance therefore tells us something about how US elections are likely to resolve, who is likely to win, which president is likely to win. And here we have a chart of the US stock market going back about, I think, about 50 years or so. And what we can see here is we can see the names on the top of the chart and names at the bottom of the chart. At the top of the chart, these are the winners. And at the bottom of the chart, these are the losers. So the presidents that won a second-term election, and on the bottom of the chart, presidents that lost on the second-term election. So we have here, if I can just start from from the past to the present, Franklin Roosevelt, second-term landslide at the market top. So after a big kind of recovery period after the Great Depression during the 1930s. Eisenhower winning the second-term landslide, and that was after an extended boom period in the equity markets. Johnson's second-term landslide win, again, further extension of boom phase in the stock market. Now, interestingly, Nixon, second-time landslide, he actually wins just as we get into the 1970s bear market, where we had a lot of volatility, hyperinflation, and many wars that were being fought. But actually, as he won the second-time election, he then, of course, had many kind of disruptive political events that took place, and then was forced to resign shortly after having won the election. So you can count Nixon as a presidential loss. And that was during a bear market phase. So what we're trying to say is bull markets tend to be good for incumbent presidents, and bear markets tend to be negative for incumbent presidents, i.e. it decreases the probability of incumbent presidents being voted a second time around. And when I say bull markets or bear markets, it has to be a bull market, generally speaking, that has been in play for about 3 years. So the bull market generally, based on statistical work which I think the Socioeconomic Institute has done in the last 200 years of presidential elections, the stock market, which is a reflection of social mood, must be in a bull or a bear market for about 3 years before the election time to actually have a real impact on the results of that election. So what we're looking at here is bull market periods for Franklin Roosevelt during the 1930s after the Great Depression, extended bull market boom for ahead of the Eisenhower second term, and then further upside under the Johnson second term win. But then we start to approach a volatile period during Nixon's presidency, and of course, although he won the election, he then was forced to resign for various political issues. And then we have Carter, which was ousted in a landslide loss, and that was following the 1970s bear market. So Carter is an example of how things can go wrong because of the financial market being in a bear mode and how that impacts social mood. Reagan, second-term landslide, that's actually after we break out of the bear market between 1966 and 1982, then we start to see how this kind of new wave, new era of laissez-faire economic growth and stock market performance after about 16 years of bear market, we start to see the beginnings of a new bull market, and Reagan during his tenure actually does quite well as a president in his results. we have, but then during that time, of course, we have a little bit of a hiccup where we have Bush ousted in a landslide loss. You could argue that it was due to a kind of minor corrections in the market, but maybe other reasons related to that. But generally, he resided over a bull market phase. Clinton's second-term landslide, certainly that was in the positive boom time of the 1990s, which is an extension of the 1980s, 1990 bull market. And then finally, Bush second-term wins by a narrow margin. That's after we get the 2002 correction from the tech bubble. And then McCain loses a landslide to Obama, and of course, then that was right at the bottom of the market. So Obama kind of managed to reign on the bottom of the market, which later on led to a 3-year bull market. Is that clear to everyone? Sorry about the I know the legends on the chart isn't so clear. One thing I did miss out is, of course, during the 1929 Wall Street crash, you have the Hoover ousted in a landslide loss. Of course, you can imagine if there's any kind of Great Depression environment, any kind of negative stock market performance, such as I think it was around an 80% drop in the stock market, that's never going to be positive for any kind of presidential election win. Now, Carlos is asking the question, according to the chart, what contributed to such a flat market during Johnson, Nixon, and Carter periods? Well, I mean, I tend to look at this in terms of long-term cycles, and so long-term cycles tend to alternate from bullish mode to bearish mode, and so there are many reasons why these bull markets switch to bear markets and vice versa. Of course, a lot of it is due to social mood and mass psychology out there around the world, but let's just say long-term cycles tend to last between 16 to 20 years, and they alternate. So I haven't actually highlighted that on the chart, but generally speaking, if you think of these long-term generational cycles lasting from anything between 16 to 20 years, basically reflecting social mood and booms and busts in the market, which alternate between bull and bear phases. Now, these can be shown, reflected on the stock market if we look at about 100 years worth of history as we're doing now. But of course, you need to keep in mind that these long-term generational cycles between 16 to 20 years don't just have an effect on the stock market, but of course they have effect on how president elections are won, and then of course what might happen pre and post elections in terms of the trades that you look at. So although we're looking at a very long-term chart, hopefully you'll see this as an interesting big picture perspective that you can apply on a day-to-day basis when you look at the screens tomorrow morning. Okay? Any questions on this chart before I move on? I then want to fast forward and focus on exactly what happened in 2012. But any questions so far on this history? Is everyone kind of finding this clear and insightful for our discussion? So Diana, Chuck, Carlos, you finding this okay? Okay, Chuck's saying yes, Constantly yes, Diana's saying yes, great. Okay, we have a consensus. Let's move on. So keep that in mind. Long-term cycles, 16 to 20 years, they alternate between bull cycles and bear cycles. They're generally influenced by social mood and many other things, but keep in mind that these generation cycles do influence financial markets and U.S. presidential elections. Now, what happened in 2012? This is the big question. And basically, I think each of you have probably answered this question just now. What happened to the S&P 500 before the U.S. election just a few weeks ago? S&P 500 doubled in value since 2009. It doubled in value since 2009. Now, of course, we had the crisis before that, 2008. 2007, 2008, where we had kind of a 50% drawdown in stock markets and financial market debacle. We had Lehman Brothers disappear and sovereign debt explode and many tail risks happen. But since 2009, we have been in a recovery mode. And that recovery mode arguably driven by a lot of money printing, so governments around the world widening their balance sheets and basically throwing money out of helicopters, as is often a metaphor used to describe what Ben Bernanke has been doing and many other central banks around the world. They've been printing lots of money to try and inflate and try and stabilize the economy. And as Chuck just said there, it got shot up by QE steroids. So well said, Chuck. Thank you very much for that fair and insightful humor. The market basically did get psyched up on artificial steroids, basically. And that has been quantitative easing, so governments basically printing more money and allowing us to think and to believe and to feel that good times are here to stay after a big crisis, which was very close to turning into a depression situation similar to the 1929 crash, which led to the Great Depression. So since then, relatively speaking, we have enjoyed better times, and of course there is a bit of a discussion, an argument as to whether this is a real recovery or whether this is an artificial recovery. Of course, the big differentiator there being the fact that quantitative easing around the world, but especially from the US and from Europe, has helped to artificially prop up the economy, the stock market, and by definition, our social mood. So if we were to kind of take that equation backwards, B equals A equals C, it kind of knocks back as well. So S&P 500 doubles in value since 2009, and that clearly, in hindsight, was a very big positive under the stewardship of President Obama, and perhaps one of the key reasons as to why he won the election second time around. Now, of course, there are many other reasons, I'm sure, why he would have won the elections, but let's just keep in mind the financial market is a big part of that equation. And what helps the financial market is social mood. And so we can say that since 2009, both social mood and the financial market, if we look at the S&P 500 as a proxy, has been positive. The S&P 500, put simply, has doubled in value since 2009. Now, of course, one point I should make here, I haven't put the charts up. If we do look at the S&P 500 or Western equity markets in nominal terms, of course the price appreciation has been very positive. But if we do look at it adjusted for inflation, it's actually half of what we see on the screen. And if we look at it compared to tangible assets such as gold, we really haven't seen much of a price appreciation in the stock market. So relative to inflation or tangibles such as gold, the stock market and the economy hasn't really appreciated in value. And of course, the average day man and woman can just look at the payment of their bills and the cost of their living, and we all know that there's a liquidity squeeze going on at the moment, and it's becoming that much more difficult to manage our own finances. So although the stock market has doubled in value, that is just showing you the outer story, but the inner story, the internal story, is maybe telling us something else. Either way, the point behind this is that the S&P 500 doubled in value since 2009, and just on that simple point, that was going to be very positive for the Obama win. Any questions on this part so far? Because now we're going to have to just speed along to the next section. Any questions, Chuck, Diana, Carlos? Yep. Okay. Now, just moving on, part two. I just want to focus on the internals, the market internals, just give you a quick technical setup to keep on watch, and then focus on the macro roadmap or my cycle kind of overlay on what's going on. Thank you so much, Gonzalo, for your wonderful feedback. Excellent presentation. I'll try and keep it excellent throughout. Thank you very much, and thank you for an excellent participation from each of you. It helps to have very good participation from each of you, Diana, Chuck, and Carlos, and Gonzalo. Now, we're going to be focusing now on the technical setup. So I showed you the S&P 500 doubling in value since 2009, and that clearly being led by that having an influence on social mood and having an influence on the U.S. election win for President Obama. Now, the story behind the story, as I told you, is the internals of the market are suggesting something else. Although the market is positive, the internals to the market are suggesting that we are in a vulnerable state of play at the moment. The markets are vulnerable. Although the S&P 500 has doubled in value since 2009, we are in a vulnerable time at the moment. And that comes back to what Carlos and Diana said about the uncertainty in the market and in the economy, magnifying the whole impact of this U.S. election event, because the markets were uncertain, even though it was in recovery mode. Now, the point that I'm making here is that the S&P 500 is still pressured by 2008 crisis peak around the 1440 mark. And we can see that following the elections, of course I told you half the story, pre-elections the S&P 500 doubled in value since 2009, but post-US election, the first week after the US elections, we had a massive sell-off in the S&P 500 and most risk appetite markets. So gold is part of that, Eurodollar is part of that, Aussie dollar, and many other markets which are labeled risk appetite markets sold off quite sharply after the US election result. So the S&P 500 being a very good proxy, as it was pressured by 2008 crisis level at 1440. The second part of that equation, of course, on the time scale, the bear market rally from 2009 lasted more than the average cycle duration. Now, it did double in value on price terms, but always keep in mind that we have to focus on the time side of the axis. And the time side of the axis, the average cycle we've basically surpassed the average cycle duration. So we're overextended in price and time terms. And remember, the market does have a memory of the past, a collective memory of the past. And both in price and time terms, the internals of the market are suggesting exhaustion, and that's why basically the uncertainty led to a massive sell-off after the US elections on the S&P 500. Now, another reason as to why we are seeing a big sell-off on the S&P 500 is because of mega cap stocks such as Apple. Now, I know the Apple iPad mini has come out, and the Apple iPad version 2 and the iPhone 5, and all of these wonderful toys have recently come out. And I'm a big Apple fan, by the way, so 100% respect to Apple. But from a stock market perspective, or a stock perspective, Apple has irrational gains over the last few years, and that very recently reversed by 25% in just 2 months. So I know if you own Apple, or if you know anyone, a friend of yours that owns Apple, they would have made a considerable amount of money in this in this stock. It has been a fantastic stock, described as the new gold out there in terms of company attraction. But keep in mind that all things that accelerate becomes unsustainable, overcrowded, and as we like to say as technical analysts, overbought. And so we had a correction, and that correction has been larger than historical corrections over the last few years. So keep in mind that Apple is a big stock. Not just it's not just one stock. It's one stock which has a multi-trillion-dollar value. It is worth a considerable amount of weighting on the S&P 500 and on the Nasdaq, and to some degree it does act as an economic bellwether in terms of economic indications as to whether we're continuing to boom or when we're starting to reverse and start to weaken. Apple is now being seen as more of an economic indicator, and of course from an internal stock market internal signal, it also suggests that the mega cap stocks, Apple, but also other mega cap stocks, are starting to weaken within the U.S. equities. Now, that was just a kind of a quick point I wanted to make there, and quite a timely one on Apple. But probably the big picture here is more on the roadmap side, and this is just a theoretical cycle diagram that I like to show in each of my webinars. Cycles generally come in threes: long-term cycles, which tend to be multi-year cycles, the big fat blue line; medium-term cycles, which tend to last from 3 to 12 months, and that's the light turquoise line, which is zigzagging around the big fat blue line, the long-term cycle. And then the red dotted line, the short-term cycle, which can be anything from 1 to 3 months, or of course you can maybe think of intraday activity as a short-term cycle. But either way, cycles come in threes: long term, medium term, short term. And the easy way of thinking about this is think about the sea, the beautiful sea or the beach, being made up of a tide, waves, and ripples. And of course, each of these different characteristics within the sea impact each other. The tide impacts the waves in the sea, and the waves impact the ripples, the very small movement in the water. And that's exactly how cycles impact each other: long term, medium term, and short term. Tide, waves, ripples. Now, why does all of this matter to you? This matters because I'm just going to quickly show you my hypothetical cycle roadmap to the economic activity within Western markets. So at the top of this chart is, as you probably can guess, the top of the market at 2007, just as we were at the height of our boom phase economically. And in financial market terms, certainly in the Western markets, things were very good in 2007, and we were willing to spend a lot of money on very expensive things because we just believed that we were going to make more money and we would be able to afford everything tomorrow morning. Of course, that party came to an end, and then we had to forego a big crisis move down in the markets. We had the, as I mentioned, the credit crisis, the subprime mortgage debacle, and many other related things. That led into the bottom at 2009, which I've just been alluding to. And then since 2009, we had a 3-year bull market into 2012. So this is great, but just keep in mind that this is part of a cycle roadmap, and this is just hypothetically what I'm trying to show to you here is we are right now at the crest of this top on a medium-term, short-term, and long-term cycle, which is a tipping point at the moment and likely to turn lower over the next few weeks and certainly into the first and second quarter of 2013. Now, this isn't the end of the world and this isn't a negative outlook per se, but just keep in mind that we're likely to have a predominant bear market through the years of 2013 and maybe 2014, the next 2 years. But within that bear market, that accelerated bear market in the Western markets, US, Europe, and the United Kingdom, we are, of course, going to have buying opportunities in some of the markets. You can see there, although it's a big down phase, let me just quickly, although it's a big down phase, there are some upside opportunities if you were looking to buy some of the markets that I'm about to refer to. So is that clear to everyone? And just so this is an economic roadmap, but of course one of the big kind of proxies you could look at is the stock market. And then if for currencies that you're looking at, think of risk appetite related currencies such as Eurodollar, such as Aussie dollar, and various other markets. Gold, a commodity market which a lot of FX traders also trade. Any questions on this cycle map? We just have a few minutes before we wrap towards the end of our webinar. Any questions? Usually the questions are on duration and on markets. So Fernando's asking the question, you predicted cycle down phase time. Yes, that's what I am now suggesting is going to happen in the first half of next year. First half of 2013 is likely to be a down phase in economic activity, and we're likely to see that shown on the US stock markets mostly. I think that the European stock markets are likely to stabilize versus the US stock markets. Remember, the US stock markets are much more overextended to most other stock markets around the world. And in currency world, just because I know, of course, we're all currency traders here, this does suggest US dollar strength over the next few months. So the first half of next year, keep in mind we're likely to see a lot of US dollar strength and weakness against the US dollar, such as euro weakness against the US dollar, Australian dollar weakness against the US dollar. So I think that this is likely to be negative for the US stock markets, positive for the US dollar, and negative for currencies, most major currencies against the US dollar. So that's how this cycle down phase for the next year or two is likely to reflect in terms of stock market performance, negative for the US stock market, stability for European stock market, and positive for the US dollar, negative for the major currencies against the US dollar. Is that clear to everyone? So I just want to make sure these trade implications are clear to everyone. I don't want this to be too hypothetical, too theoretical. Okay, great. So Diana's saying that's clear. Fernanda's asking the question 1.5 to 2 years. Roughly, it's 1 to 2 years. 2013. I mean, this changes all the time, and so I'm looking at the cycle kind of proxies on a daily basis, weekly basis, and a monthly basis. So this does change, but generally speaking, from a macro perspective, we are moving into a negative cycle in Western markets over the next year or two. Of course, keep in mind that during that bear phase, during the next year or two, there are likely to be small windows of opportunity, of buying opportunity during that time. So it's not just a straight line move. As we all know, markets do zigzag in different directions. But generally, the overall cycle, that big fat blue line, the long-term cycle, will be down. Okay? But keep in mind, of course, there will be a short-term cycle moving up and down and a medium-term cycle, which will probably be more on the downside, but maybe also create some opportunities during that time. Yes, and this will involve equities and commodities. I didn't mention commodities, but yeah, I'm focusing more on equities because that is probably the best proxy for the for the economic activity. The stock market is a great indication of economic activity, and so this U.S. stock market would be more negative over the next year or two. But for commodities, it depends which commodities we're looking at. So whether we're looking at energies like oil or natural gas versus precious metals like gold and silver. I'm positive on gold and silver early next year, but I think at the moment we still have further downside on gold and silver. And keep in mind that gold and silver has been behaving more as a risk market than a safe haven for the entire year of 2012. Gold and silver, gold specifically, has been moving sideways and has been behaving more as a risk market, not a safe haven market. So keep in mind that there's this dangerous double face to gold and a few other markets out there. So for the moment, gold is negative for the short term to the end of this year, I believe. But early next year, it's likely to be positive. And I gave a webinar on that last time. Feel free to check the archives for that. Okay, so just a quick summary on this cycle location. We've had a wonderful boom phase up to 2007, which is the top of this chart. Then we had, the correction to that big party where we had to kind of wake up and just smell the reality. And that was 2008, the big 50% drawdown. And 2009, we had a major bottom where we had a 3-year rise in the S&P 500, which doubled in value since 2009, and that was clearly positive for President Obama and his second-term re-election win. Now, what I'm suggesting is that 2013 onwards, we are likely to have a down phase in economic activity, which is likely to be reflected the most in the stock market, specifically the U.S. stock market, which is likely to be more negative than the European markets. Asian markets, I think, are going to be maybe potential stable to outperformers over the next year or two, but it depends which Asian market we're looking at. Diana's asking the question, oil. Oil is a different case in point, and I'm in two minds on oil. I'm not so clear on oil at the moment, but at the moment oil is negative, but I do see risk to spikes in oil over the next few months. Certainly early next year, I feel that there are more risks to spikes in oil due to studies that I look at based on volatility studies, but also due to the macro risks that are starting to mount in geopolitical regions such as the Middle East. Is that clear, Diana, on oil? So I'm mixed on oil at the moment, but do see upside risks for oil early next year on the back of various volatility studies which I look at, but also mounting geopolitical risks, specifically in the Middle East. I think you know what I'm referring to. Okay, now that leads us to the third and final part in the last few minutes of this webinar. And we're going to talk about a few strategies. I'm just going to focus on risk appetite and how I believe that markets which are high in risk appetite are likely to unwind lower. I've already mentioned them several times, and how safe haven investments are likely to be good investments over the next few weeks and months. Keep in mind that the word safe haven has changed its characteristic for the entire year of 2012. So you have to be very selective in terms of what is still a safe haven market. Now, my answer to that is the US dollar and potentially gold eventually early next year. But US dollar is likely to be a big safe haven play, and we're already seeing big gains in the US dollar. Now, just a quick focus on euro dollar, and then I'll switch on to the US dollar. Euro dollar mean reversion risk beneath the 200 moving average. We've had some recent positive moves on the euro dollar, and that's been on the back of the potential agreement for Greek bailout or Greek payment, so the kind of rhetoric which is coming out of Europe now. But generally, euro dollar is still negative after breaking out of this 2-month range. And the key support levels on euro dollar is 127.19, 125.92, and 124.64. These are just key Fibonacci levels of the prior uptrend. There are other things that I'm watching, but just very, very simply, the 200 moving average is key. We need to push back below that, and then we're likely to hit those support levels just highlighted on the chart there. And keep in mind, this is not just a euro story. This is also a dollar story. This is euro negative, but more specifically, this is US dollar positive. Now, keep in mind, this is a chart here of the US dollar index, and we can see here, going back to 2010, we can see that ever since 2012, so mid last year, the summer of last year, the US dollar bottomed and started to unwind from extremely oversold levels, and is now building up very constructively into this kind of accumulation recovery that we're starting to see. Now, from September onwards of this year, just to kind of focus more on the short-term cycles, we have been very positive. We can see here, after the sharp setbacks during the summer, so during the summer when we had risk appetite markets rising in value, the dollar index fell in value, but ever since September, October, and into November, into the US elections, we have had further positive price activity in the US dollar index. And in my opinion, that is likely to continue much higher into the old highs at around 84. So keep in mind, US dollar strength is my view over the next few weeks into year end, and more so I think we're going to get very sharp accelerated upside in the US dollar early next year. So watch out for that. Likely to be very fast moves. And actually we're simply unwinding from extremely historical oversold levels, both in momentum and liquidity terms, but also, I mean, i.e., many people have been selling the US dollar for so long, and so just on the back of that became overcrowded, and now we're unwinding. But also keep in mind that from a macro perspective, the US dollar is seen, whether you agree with it or not, as the last safe haven standing. It is still the reserve currency of the world, or certainly the most stable reserve currency of the world. And so for that reason, whether the US still has economic problems or not, and whether they'd like to increase or not, it's still seen as a safe haven, the ultimate safe haven. And keep in mind that many other safe havens have fallen out of favor. Think of gold moving sideways ever since it pushed just under $2,000, moving sideways for the entire time of this year in 2012. Think of the Swiss franc after the Swiss National Bank intervened and said, we don't want investors making our currency expensive. It's not good for our exports. And so they intervened with a large amount of liquidity and stopped people from doing that. And the yen, more specifically, as some of you are asking, Fernando and Black Cat, I think is also a very big trade over the coming weeks. Of course, you can already see that. Now I'm going to actually just focus more on the yen. So I'm glad that you mentioned the yen. The yen's a very big part of my portfolio, and this is something I've been very dollar yen I've been very bullish on, and Japanese yen very bearish on ever since late last year. And some of you might remember I was bearish on the Japanese yen, calling for a very long-term cycle reversal on the Japanese yen. So Japanese yen weakness across most other currencies. I was a little bit early, actually very early, to be honest, on that call, but there were reasons why I made that call. But we're starting to see that long-term reversal reactivate again. So timing is everything, and of course, we cannot always get the timing correct, and the Japanese yen was undergoing a massive transition time, and often with these long-term cycle transitions, they tend to take much longer than we expect. There were early signals of this transition last year after the unfortunate earthquake in Japan, but many cyclical signals suggesting this reversal in Japanese yen. We did see the reversal, but then the market just continued to base and to continue to be very volatile. Keep in mind that the dollar yen is often described as the pain trade, and yes, it was rather painful for me for the duration of this year. But back when I made the call on dollar yen upside and Japanese yen weakness, one of the big suggestions I made, and you can see this on the FX Street webinar archive from last year, was to use option contracts, because on a directional basis it was very difficult to pick a turning point that would have made you money on dollar yen for a long amount of time, whereas the option market, generally speaking, could have been that much more profitable, because you could have just taken a certain maturity out and maybe tried to hedge for that upside on dollar yen, downside on Japanese yen. Now, here we can see a major breakout on the dollar yen. This is likely to target the 2012 high at the March peak at 84. So I do believe that dollar yen is likely to hit 84. On a near-term basis, we are definitely overbought. We just triggered a bearish reversal candle pattern just today, so we are likely to unwind from overbought levels over the next few days. But over the next few weeks and certainly into the year end, dollar yen is likely to hit 84. Keep in mind, in the last few weeks alone, it has rocketed up 7% in just a few weeks. So this is proving to be a very fast-moving market. And in terms of the key drivers, keep in mind this is a double positive. US dollar strength and Japanese yen weakness. There are two reasons why this currency is moving higher. One, because the US dollar is gaining in value generally, and two, because the Japanese yen is weakening in value. So that is adding a double positive effect to the market. So we'd like to see a lot of upside in dollar yen. And of course, euro yen is another proxy that I would encourage you to look at. Now, one of the key things to keep in mind, and this probably ties in with this whole talk about the fiscal cliff question, which is coming up into early next year, is of course government interest rates. If we look at the US long-term 10-year yields, it is my opinion that we have just marked a cyclical reversal, upside reversal in long-term US 10-year yields. And that happened in the summer of this year. I think that yields are likely to gain and appreciate in value into year-end, but more specifically early next year, as the US government starts to wrestle with this fiscal cliff debate. I think that long-term government rates in the West, but specifically in the US, are likely to rise, and so we're likely to get inflationary pressures come back into the system. And I'm calling this the sleeping giant, which is about to wake up in 2013. The sleeping giant, which is likely to wake up in 2013. So all of that money printing, which has been taking place over so many years, and all of that quantitative easing, is likely to change for the worse, and the patient is likely to wake up, and we're likely to see higher rates. So keep in mind that on the chart here of US 10-year yields, the 200-week average is key at 178. We have on 3 occasions attempted to break above the 200-week average, and we haven't. We failed. Now that is generally a negative signal, but we are still holding ground within this kind of range price activity. And I believe that if we do retest the 200-week average and break above, that'll be a major bullish signal for US long-term rates. Now, you have to keep in mind what that means. If we do get a breakout of US 10-year yields above the 200-week average, what that means for the economy in terms of borrowing costs rising. What does it mean for your mortgages? What does it mean for just general economic growth? But also, what does it mean for currency world? So in terms of the US dollar, is that likely to increase the return on US dollar and the carry on US dollar being weaker than usual because of this? What is this likely to mean? And of course, Fernando's making a very good point here. Could this lead to a recession? Of course, that's another economic implication. And I do have a very good chart on economic recessions suggesting that we might have another recession in 2013. I don't have it in this webinar, my apologies, but I can include it in future webinars. So this is my kind of final summary on US 10-year yields. I'm going to stop there, and if you have any questions in the last few minutes, I think I'm out of time. I can hold up. So Gonzalo's making a very good point there. Negative for stocks, absolutely. At this stage of the cycle, it would be negative for stocks. Okay, that's it for my time. I always like to end on time as much as possible. And my mantra is enlightenment through realized knowledge. I truly believe that we learn from each other all by sharing knowledge. And that's why I like to have interactive webinar participation. It has been an honor and a pleasure hosting this webinar on the U.S. elections and how social mood impacts the financial market and impacts the U.S. elections. And keep in mind that my next webinar is actually going to be on the Japanese yen, long-term cycle reversal revisited, for some of you die-hard attendees that have seen my work previously on the Japanese yen. I can send you the previous report, and I'll be writing an update on that report posted last year. Japanese yen long-term cycle reversal revisited, Wednesday the 19th of December, so just before the holiday season. Please attend in advance, just so we can see how many people we're likely to get for that webinar. It's likely to be a very topical webinar, especially with what we're seeing here on the Japanese yen technical setups. Wednesday, the 19th of December. I look forward to seeing you there, and I think the FX Street team will likely to put the link in the chat just so you can sign up today if you want, or over the next few days. So thank you very much, and thank you all for your wonderful feedback. I can see Gonzalo here saying beautiful analysis, and true treat to hear you from Fernando. Thank you very much from Dana, and yeah, a big thank you to all of you, and thanks Boyke for your continued support. Thank you very much, everyone. Honor and a pleasure. Ron William, technical strategist at RW Advisory, based in Switzerland, signing off. All the best. See you on Wednesday, 19th of December. Bye bye.